Hello again, everyone. This is Ken Martinez with Mark Investments and introducing the next video in our series of the cash flow calculator. Today is selling a note. So let's go ahead and click to our amortization table. So on the amortization table tab, this is a complete amortization table. You put in the input values. Right now, as an example, I just have a 100,000 loan, a 30-year mortgage for 100,000, 6% interest, and that's almost a $600 payment. It'll produce the amortization. Then if you want to correspond it to a actual loan, just put in the starting date of the loan so that it will correspond for you. But it breaks everything out for you all the way down to the bottom, the last payment, and it does zero it out. There's a couple of things you want to make sure on your amortization schedule. You do want to make sure the last payment ends at zero. It balances it out because that's after the borrower has paid every month. Should end up with a zero balance. The other thing you want to make sure is that the total amount of principal paid equals the original loan amount. These two should total out. Right now I'm totaling this entire column, so these two should match. Just double check those things, that these match and that it ends in a zero balance. Most of the time when you see an amortization schedule, you're going to see a couple of graphs. One where you in a percent of where the principal and interest payments are broken out by the percent of the payment, and another one where they show the cumulative totals paid. So how do you interpret these graphs? Let's just focus on the red line right now, the interest paid. The way you interpret these graphs is when they intersect, this is a point, kind of like a magic point, where most of the loan now is being paid towards principal, which is a good thing if you're trying to get that loan paid off. So in the beginning, most of it is interest. So if you take over a loan here, that as an investor, that's not a good thing because most of the loan is still there. You own the entire balance. So if you can take over a loan closer to this part, that would actually be a good thing as an investor, because the borrower has already paid much of the cost of the loan in interest, and now the majority of the payment after this part is going towards principal and not as much to interest. So that this ends up being the magic point. That's what you want to focus on. So it doesn't matter if you're investing in first or second mortgages. If you're first mortgages, then you're looking at a deed in lieu right here, not a problem. If you're investing in second mortgages, then you're not afraid to take over, foreclose on that property and take over that first, because you know that most of the interest has been paid for now, and you can just continue to pay on that first, knowing that most of it is going towards principal. So it's a good thing regardless of first and seconds. Let's show the effects of lowering the interest rate. So it was at 6%. If I lower it to 3%, notice that brings it way to the left, which is a good thing because it increases the, it makes it sooner when you start paying more in principal. So this would be a good thing again in terms of an investor. If the majority of our payment is going to principal rather than interest, then it makes it easier to take over that loan. Consequently, if we change it to 9%, just as you would expect, it's a much higher interest rate. It's a more expensive loan. There's a lot more cost in the beginning, and when these crosses gets pushed out farther to the right, it's going to make it harder to take over that loan because of the high interest rate. So something to think about in terms of taking over loans on or buying like a seller finance loan or something like that. How about the second part, this second loan here? Let's go back to 6% here. So this is, again, focus on the red line. This is cumulative totals. It just so happens the way the math works out, why this graph is important, because when the red line crosses the balance, at this point, the total amount of principal and interest paid on the loan is equal to the actual beginning loan amount. So at this point, 100,000, the bank, if this was a regular bank loan, at this point around month 170, the bank has $100,000 back of principal and interest. So they have all of their capital back in a sense, which is, I think that would be a good thing in terms of negotiating. Maybe you're negotiating a short sale, so they've gotten their money back at this point. How does that affect in terms of interest rate? It really has a different effect here. the lower the interest rate, the farther to the right it pushes out, because the bank, there's not as much interest being paid, so the bank is going to have to wait longer to get their money back. And same thing is just what you would expect if you change it to 9%. Much larger interest rate, a lot more interest being paid in the beginning, so it's going to bring the time when they're going to get their principal back farther to the left sooner. So this is going to be probably better if you're looking for a short sale here. Anyhow, there's some guidelines on how you interpret these graphs and really what they mean. I have a table here and that adds up the total amount of principal in 5-year increments. So you can see in the beginning there's only about 7% being paid out, and then it increases. Again, everything we kind of know about a loan, and then in the beginning most of it is interest, and as it gets later, the amount of principal that you're paying compared to interest increases. So in the very last 5 years, you're going to end up paying a full 31% of the total principal paid in those last 5 years. And I think that's about it. So the other points, or I did want to show you a couple of things, is what happens if you want a balloon payment. You could put a balloon, like if you say you wanted to end up the loan with $5,000. Notice the balance will end up with $5,000. Also notice that the total amount of principal paid is now $95. It's not going to be $100 because there's now a balance. These two are going to equal that, and you're going to end up with $5,000. Change that to $10,000. Same thing, your balance at the end now is what we're saying. You're going to end up with a balance of $10,000, so total principal paid is $90,000. What happens if you want to pay down pay down the principal? Say you want to give an extra $20 a month. How does that affect? Right now, this is the 360-month loan. So if you pay an extra $20 a month, you're actually going to pay out now on month 330. So paying an extra $20 reduces, takes off 30 months of payments on your mortgage. So if you want to calculate the effects of prepayment, you can. Let's go to the partial now. Partial is really the same thing again as I mentioned in the overview. It's really just two amortization schedules. One for your original here. I just have the example. It's what I have, 300 months, 7%, $85,600 payment. And let's say in order to recoup some of your capital, you want to sell 120 payments, 10 years. You're going to get $40,000 for this, for 120 payments. Now, you're going to get, the borrower's going to get 120 payments of $600 a month. So since they're paying $40,000, but this bottom number is really what they're receiving, the present value of 120 payments of $600 at 7%, that's really worth $51,741. But they're not paying that. That's what they're receiving. They're actually paying this. And since they're paying less, their yield is not going to be 7%. It's going to be more because they're paying less than what they're receiving. So it's a 13% yield to them. And so that's how the partial works. The question, though, is what happens if the borrower pays off early? So I put a little scenario here for you here. If the borrower pays off, say, after 3 years, and that's what this graph is showing. So 36 is going to correspond to the vertical line. The original payoff of the note is $80,800. That's this first one. The partial note payoff, what is a partial person going to get? They're going to get 32, almost 33,000. That's this loan. And the difference from here to here is this 47,009. That's what's going to go to the seller. The question is, notice this amortization down here. The amortization is based on $40,000. That's what they gave us. So what's interesting though is if you're the seller, that's probably what you want to do, is create the amortization schedule off of that. Meaning, if they paid off in the first after the first month, what the partial person is going to get is their payment of $600 plus their balance of $39,800. They're not going to get this amount. But if you were the buyer of this partial, you may want to negotiate and say, hey, I'm buying this, this is what I want my amortization schedule based off of. So I'm giving you that option to say, are you the seller or the buyer? Look what happens when I click this. The partial note payoff amount right now is almost 33. And if I change this to a buyer, they're going to get another $7,000 if it pays off at month 36. So it makes a difference because the amortization schedule is now based off of what they're receiving, 51,741. So there's no right or wrong way to do this. It's just a matter of what you negotiate. But if you're the seller or the buyer, you may want to try to negotiate basing your partial amortization on this if you're the seller, or this if you're the buyer, because it's going to affect if you have an early payoff amount. Anyhow, that's all I have for this. Let's go back to the beginning, and that's it. Again, this is Ken Martinez from Mark Investments. If you want to know how to invest in this cash flow calculator, send me an email at mark55llc@gmail.com.